Okay, this is chapter 5, homework question number 1, and I am going to rework this and go through the steps. On February 3rd, purchased $3,200 of merchandise inventory on account under terms 110, so a 1% discount if we pay within 10 days. So to record the inventory, you're going to debit merchandise inventory, and you can look on the notes, the buyer notes. When you purchase something on account, you always credit accounts payable, and you do not worry about the discount as a buyer until you pay, and then if you pay within the discount period, you calculate the discount. A little bit different for the seller. So we do not have to do a description. And then returned 700 of defective merchandise purchased. So when we return it, we didn't pay with cash, we charged it to accounts payable. So now we no longer owe it. So we're going to debit accounts payable to decrease accounts payable by 700. So now we only owe 2,500 when we pay. And then we want to reduce merchandise inventory because we sent 700 of it back. Then we paid a freight bill, and as a buyer, if you pay freight to order your inventory, it is included in inventory because it is a cost to get the inventory to us. So it's part of inventory when you are a buyer. If you're a seller, you record it as a delivery expense. But as a buyer, you put it in inventory. Now, we sold, and now we're the seller. We're selling inventory on account for $4,000. When you sell, you go ahead and calculate the discount. You only record the sale. I believe it's accounts receivable. You record the sale at the discounted price. So if you do 4,000 times 0.03, the discount would be 120. So 4,000 minus 120 is 3,880. So as a seller, you don't record the sale at the full amount. You record it at the discounted amount. When you're a buyer, you don't worry about the discount until you pay. It's exactly opposite for the buyer and the seller. And then you have to debit cost of goods sold and credit merchandise inventory because your sale is $3,080, but that's not full profit because the good costs $2,000. So $3,880 minus $2,000 would be a gross profit of $1,880. This goes on the income statement, and this goes on the income statement. So that's why we have to record both of those. And then we have to record accounts receivable because they're going to pay us later. You also have to reduce inventory for $2,000 because it's being sold. So you have two entries when you're the seller. And then we have to pay the amount owed on February the 12th that we purchased on February the 3rd. Remember, we purchased $3,200, but we returned $700. So the accounts payable is $2,500. Did we pay within the discount period? Well, we paid 9 days later, and we had 10 days to get the discount. So we're okay. So we're going to get a 1% discount. What that means is we're going to take off our accounts payable for the full amount. And I believe we said it was $2,700. The sale minus the return, because it was $3,200 minus $700, so it's $2,500 instead of $2,700. And then we had a discount of 1%, so we need to reduce inventory because we're not paying $2,500 worth of inventory. We have a discount of 1%, so we need to reduce inventory by the discount, 1%. So we don't record it as a discount, we just recorded the discount as a reduction to inventory. And then you have to credit cash 2,500 minus 25 for $24.75. So we paid $24.75 for the inventory. Remember, we recorded the inventory as $3,200 minus $700. We recorded the inventory as $2,500, but we only paid $24.75 for it. That is why we had to reduce inventory by $25 because we got a discount. So we recorded it for $2,500 and then we reduced it by $25. So now inventory is on the books at the cost, which is $24.75. Inventory has to be recorded at how much we paid for it at the cost, the amount of money that we actually paid for the inventory. Received cash from February 10th customer in full settlement of debt. So we received cash in full settlement of debt from this customer. They had 15 days to pay, so they had to pay by February the 25th, and they did not. So they have to pay us the full amount. Well, the full amount is $4,000. So we're going to get cash of $4,000. But their accounts receivable was recorded at the discounted price, which is $38.80. So we take all of that off, but we have to make the debit and credit balance. So we would credit sales discounts forfeited. This is only a seller account. You wouldn't do this as a buyer, but if you're selling something and the buyer does not pay within the discounted period, then at the end you make an adjustment. So I think that's going to be $120. Okay. Question number 2. Let's look at it. Journalize the required journal entries at March 31st. Start by closing revenue. Remember, to close revenue, revenue has a credit balance, so we debit it to close it. So revenue is $239,000. So we will credit it for $239,000. And we would debit it, and we would credit income summary for $239,000 to close revenue. Okay, and then we're going to close all your expenses. So we're going to debit income summary and credit all of our expenses. We have cost of goods sold. And then we have selling expense. And then we have administrative expense. And then we have interest expense. And we are closing your expenses. So what I have to do is I have to add all those up. So $107,550 plus $27,300 plus $14,400 plus $2,700, and that would be $151,950. Now we have to close income summary. Well, income summary has a credit of $239. That's your revenue that you closed it in it, and then you close your expenses to it, and the difference would be $87,050, and that would be a credit balance. So to close it, we're going to debit it for $87.50, which is the difference between those two. And then we're going to credit retained earnings because we're closing it to retained earnings. Then we have to close dividends, and we credit dividends because it has a normal debit balance. And we're going to debit retained earnings. Dividends makes retained earnings go down. Net income makes retained earnings go up. When you debit retained earnings, it has a normal credit balance. So when you debit it, you're making it go down. And dividends is $40,000. So we're closing out dividends, so it will have a zero balance. Now all you're going to do is review the closing journal entries, and it says use the closing and show for income summary, calculate the balance, then show the post-closing balance on the last fourth line of the account. So I think we're doing everything. Income summary, closing, we credited income summary for $239,000, and then we debited it for $151,950, and then we debited it for $87,050. First, we had a balance over here of $87,050. It says for income summary, calculate and enter the balance before posting the entry to close out the account. Post the entry to close the income summary account on the line after the balance prior to closing. So we want to do our third entry here, and then our balance is zero. And then for dividends, let's do retained earnings. Retained earnings, we had a closing here. We credited it for $87,050, and we debited it for for $40,000. So the balance in retained earnings is $2,700 plus $87,050 minus $40,000. So you get $49,750. And then for dividends, we closed it on the 4th for $40,000. So the balance is zero. And income summary, okay? And that is pretty much it. And we know it had a net income of $87.50. That's pretty much